Hello, everyone, and welcome back to another episode of the Trader's Mindchat Show. I'm Mike Lamothe, and today we are diving into something that every trader faces at some point: FOMO, the fear of missing out. Whether you are just starting on your trading journey or you've been in this game for years, the urge to jump in when you feel like you're missing out on the action, it hits all of us at some point, right? So if you're underinvested and you're trying to catch up, it can be even worse. And the pressure to make a quick move in the market can lead to some of the biggest mistakes a trader can make. But don't worry, I'm going to show you how to overcome that urge and, more importantly, how to gradually rebuild your exposure without taking on too much risk. We'll even break down some live charts together to spot safer entry points. As always, stick around because we've got Q&A coming up later on where you can ask me pretty much anything that you want. So if you're ready, let's get into it. All right. So, first, the danger of ramping up too fast. So, let's talk about why FOMO is so dangerous. FOMO is dangerous because if you've been sitting there watching the market rip higher and higher and higher, you could feel like you're stuck on the sidelines. You know that if you're sitting there on the sidelines and you feel that urge to jump in, it's it could be very frustrating. It could be where you feel like the market's going to leave without you, and that if you don't get in right now or try to do something, that you're going to miss the boat, right? Fear of missing out. That's the problem, though. When you act out on the fear of missing out, you end up abandoning your plan. So it's kind of like trading like you're on tilt, making emotional decisions instead of smart ones. So guess what? That tends to lead to a snowball effect. You end up making one bad trade after another, and then you're trying to chase your losses by taking even bigger and bigger risks just to catch up. And before you know it, you're in this massive hole. We want to avoid that. And it's easy. It's easy to fall into the trap, but the deeper you go, the harder it is to get out of that trap. And before you know it, you're not just underinvested, you're digging yourself into a hole that's even harder to climb out of. And that's why catching up isn't just about speed, it's about strategy. You need to rebuild smartly, not just quickly. So, how do you catch up without making all these emotional mistakes? It starts out by facing your fears head on. FOMO is driven by fear, right? Fear of missing out on gains, of being left behind, of watching the market soar while you're stuck on the sidelines. All that is driven by emotion, by fear, by an underlying belief. But here's the thing: if you don't address those fears directly, they're always going to end up influencing your decision. So the first step is to recognize that missing out on a trade isn't going to be the end of the world. Sure, it feels like it when you see a stock running and you're not in it, or maybe you were in it partially and you sold some and now it's going up a lot and you're like, "Oh man, I should have held on longer." But guess what? The market is always going to offer new opportunities. One of the things that I always like to say is that the market is an infinite stream of opportunity. It's not about catching every single wave, it's about catching the right wave. And the right wave is the one that aligns with your plan. Once you acknowledge that fear, you can start to replace it with a better alternative. Instead of rushing in, you want to rebuild exposure gradually. It's very tempting to go all in and try to make up for lost time. But that's where traders get it wrong. Instead, what you want to do is scale in slowly. Here's what I recommend: set predefined rules. Rules for when you'll add to your position. For example, let's say you hit a certain target or there's some technical indicator that you track that confirms your trade. Then after that, then you can increase your position size. And by following a system like that, you're starting to take the emotion out of it. There's less guessing and less jumping in on a whim. You're following a plan. But here's something else that goes along with that. When you start to have those small wins and following your plan is a win. But as you start to build up those kind of wins, as you start to build up wins that translate into profits, that's going to start to build your confidence. And it's like climbing a staircase one step at a time. You get a much better view with every step, but you don't risk falling all the way down by taking one giant leap. Now let's talk about having a game plan. And I cannot stress this enough: how important it is to have a plan. If you don't have a plan, you're basically flying blind. A written trading plan, and not just a trading plan, but a business plan, is going to be your guide that tells you exactly what to do, especially in those moments when you're feeling emotional and tempted to make impulsive decisions. Your plan should cover more than just entries and exits. It should have a layout to analyze for what you're going to analyze and when you're going to analyze it. Knowing which indicators you're going to check out, what setups you're going to focus on, and having rules for when to act. This is going to keep you from chasing every signal and having fear, because your plan has thought through many of these things. Plus, your plan should account for risk limits and target gains. So that way you're always in control of your trades. You're not leaving them to chance. Now I get it. I get it. Writing a plan can feel intimidating. Believe me, I've been there. It can seem overwhelming. It can seem like this is going to take a lot of time, especially if you don't know where to start or what to include. And that's exactly why I wrote the Trading Success Blueprint, your ultimate guide to crafting your trading business plan for profits. In this guide, I walk you through everything: what to analyze, when to act, how to structure your plan for long term success. Whether you're refining an existing plan or starting from scratch, the Trading Success Blueprint will have you covered. So if you don't have a solid plan yet, now's the time to start building one. And I've made it as simple as possible for you. This is going to be the key to keep you grounded as the market starts to get chaotic. So if you haven't grabbed a copy of that yet, I will drop a copy of that into the chat for you guys. And there it is. Go get a copy of it. And if you've gotten a copy of it and you haven't read it yet, then go read it. It's definitely going to help you. Okay, so let's switch gears and look at some live charts. Now, when I say safe entry point, right? How to enter safely, I don't mean that there's no risk, right? So let's switch over to the chart set and I'll show you what I'm talking about over here. All right, so here's an example. I don't mean safe in that the trade can't fail, right? It's what I mean by safe is that it falls within the risk parameters of your trading plan. So let's break it down. and this is a trade that I'm in right now, Duolingo. And this one is one that's worked out pretty well so far. From where I bought it over here, it's about the 24%. So what makes this so great, right? It's not that it worked, right? Don't get fooled by thinking, oh, well, you bought this, it went up, that's the reason why. No, that's not what makes it safe. What makes it safe is that it follows the reward to risk ratio, right? So let's break it down. Let's say that you usually risk 5% to make a potential 10%, right? So this is roughly 5% risk. And let's say that your target was down here at about 240, right? Now you've got a solid 2-to-1 reward to risk ratio. But if you're chasing a trade, let's say that you missed this one and you're like, oh man, you know what? I should be buying. Let's say that it's up here, right? Let's say that it's at $230 and you don't know exactly where it's going to go, but you're like, you know what? I think I'll hop in over here. And now your stop is way down here. Well, guess what? Now you've messed up your reward to risk ratio because you don't know where it's going to go. And let's just say that you get to where price is now, right? And it's not a great trade. Look at the reward to risk. You risked 1 to make 1. That's not going to be worth it, right? If you have a 50% win rate, that math isn't going to work for you. You're exposing yourself to a lot of unnecessary risk. So to find the quote unquote safe setups, the ones that fit within your plan, we need to look for confirmation signals like a breakout from a base or a bounce off of a support level. But these signals are all part of the reward to risk. So, well, with Duolingo here, right? Well, what made this one so great? The thing that I was looking at, or one of the things that I was looking at, was that this was setting up in a what's called a double bottom base, and it actually formed a little bit of a handle right over here. Now, part of what made this trade look excellent to me is that price started to tighten up over here. When price starts to tighten up and it's starting to show that there's this momentum and it's getting ready to break out, right? And I could tell that it's getting ready to break out by looking at the action right over here and seeing that, oh, you know what? Price has been hanging out below that 215 level, not just over here, but all the way back here and even back here a little bit. Great. So that's an important level. And then I could see what price is doing right now. I could see, oh, price is starting to bounce around and get tighter and tighter over here. What's that level of tightness? It's only 5%. Take a look at my business plan. Wow. So typically I risk on average about 5%. I know that not just from the business plan, but also from my journaling. My trading journal keeps track of all my trades. And so I'm able to see on average, how much do I risk per trade? I'm also able to see how much do I make per trade? On average, I'm making about 10% or so per trade, sometimes 15%. On average, I'm risking about 5% or so per trade. So the math works, right? And I'm right about half the time. So this fits right in there. And by looking at the price action and looking at a few other things on this chart, I'm able to say, you know what? This is actually a good opportunity. Let me put money into this one. And it's safe because the math, right? It's not safe because Duolingo's the best company in the world, right? You could, whatever you think that the best company in the world is, you could lose money on, right? But it's all about the action. It's all about price. The price is the only thing that's going to pay us. So a good company could go down. A bad company, bad could go up. The only thing that pays is price. And so we need to have ways to assess, well, what's a good opportunity? Part of what helps you assess what a good opportunity is, what a safe opportunity is that the math works. This part here, that's the math. Questions on this part? All right, see, question coming in from Caleb. All right, Caleb says, how would you manage VST? Let's pull up VST and take a look. All right, VST, I was in this before today, but after today, I wish I had more. No chasing. Okay, so I like to have multiple ways to exit trades. I like to have 4 ways that I'll exit a trade. The first way is setting profit targets. So I like to scale out of trades on the way up. And I will typically scale out of trades at various multiples of what I've risked on the trade. So, for example, if I've risked 5% on the trade, then I want to start scaling out of the trade at least by 10% once I've made 2 times the amount that I've risked on that trade. Then I'll exit at another multiple and another multiple. But it's not just blanketly mathematical like that. If you're starting out, you could do it mathematically and make your life easier. And that's what I would recommend for anybody that's starting out. What I've integrated into the math part is to say, okay, if price moves up 10%, is there a meaningful level that coincides with? Right? So, for example, let's go back and take a look at Duolingo. Right? So I'm already out of half of Duolingo, but I was out of half. It was out of half when price got to about here, right? And you might be saying, oh, wait a minute. You were risking about almost 6% and you got out of half of it at about 9%. Why would you do that? The reason why I did it that way was because price was getting to this gap up over here, right? So prior resistance, a logical spot where price could have started to pull back in. So those are some of the things that I start to factor in. Other levels. I look at Fibonacci retracements, things like that, things to help me to add a layer of confluence around the targets. Here's another way that I like to exit a trade. We spoke about this one just the other day. It's called danger signals. What are danger signals? Danger signals are signals that are hinting at a shift in momentum. Any one of them by themselves, not that big of a deal. If you get a lot of them all at once, then it can be a big deal. And so let me pull up VIRT and I'll shift over to TradingView to show this one. Now, this is one that I shared yesterday. And yes, right now there's 8 danger signals on this one, but yesterday there were 11 danger signals. All right, let's come back to yesterday and get this thing to update. There's 11 danger signals on this. So that's telling me, whoa, there's a lot of evidence that this thing might pull back further. So I want to lock in my gain there because there's a distinctive momentum shift. So there's 2 types of exits. A third one is setting a backstop. What's a backstop? It's basically just raising your stop loss, right? So everybody familiar with what a stop loss is? So whenever I raise my stop loss, I call it a backstop. And the way that I will raise that backstop is when price structure develops. So, for example, over here, right, let's make this red so that way you could see it a little bit better. Make it, is that bold enough? Yeah, I think it's bold enough. Yeah, that's a little bit bigger. So price developed a support level structure right around here. You see how price pulled into the 21 day, that purple line, and then bounced, and how this area also corresponded with this prior high. So there's arguably a support area down here. So I would place a backstop there just in case if price comes down, touches it, and then falls through the floor. Yeah, then I don't want anything else to do with it. I'll take my gain and I'll sit and wait for the next type of entry. And then the fourth type of exit is the stop loss. So I've got 4 ways to exit a trade. 3 that are going to exit with profits, 1 that is going to cut the loss. All right. So now what I'm interested in is to answer your question of wish I had more and not to chase would be to have rules for and re-entering, right? So when are we going to re-enter a trade, right? Well, we've got a winner, we've sold out of it, or we kind of wish that we had more, but where would we re-enter, right? VST, this the right chart here, VST. Looked a little different on deep view, VST. Vistra Corp. Yeah, that's a little weird. All right, but let's say that we want to re-enter this. What I would want to do is see, well, are there any other patterns that are being formed here? Right? I'm not exactly sure where you entered, but I see a couple of different ways that maybe somebody might have entered. Here's one down over here where price was getting back above the 50-day moving average and above a descending trend line. Maybe over here was another one. All right, let's make that a little bit thicker. Maybe that was an entry getting in over here. Well, where's price now? Just below the prior chart high. And look how far it's run since then, right? It's run almost 50%. And are there any nearby moving averages or anything? Well, it's extended from even the 5 EMA. The 10 EMA is way down here. I think that it needs to settle down a little bit, to be honest. I wouldn't be looking to add right here because if let's say that price breaks out further, right? Let's say that it stays there and then on Monday it starts to break out again. How would you manage your stop? This is the first way that I would look, right? It gapped up today. You're at resistance. If price follows through, is setting an entry above today's high with a stop below today's low, right? Because it's a gap up. If a gap up is part of your business plan, okay. If gap ups are something that you trade, okay. If they're not, then you're not doing this. But if they are, then the next thing would be, does the math work? Well, the math says that you'll be risking 8.5%. Does that fall within your statistics? Are you making on average 19% for your trades? Because if not, then the math might not work out. Then in that case, I might look for a tighter way in. And another thing that I would be asking myself also is this a high quality setup? That's something that I'm always asking myself. Is it a high quality setup. And the reason why I'm always asking myself, is it a high quality setup? Because I might be very interested in this one and I had it. And there's a little bit of an emotional attachment, right? Because I bought this thing, it went up, it did what I wanted, right? We're making some money here. But every entry should be weighed on its own merit, right? Just because it's done well, that doesn't mean that this next trade is going to do well. We want to enter right. So how do we do that? The way to do that is another part of the trading business plan that gets outlined, and hopefully everybody will build this, is a model book. A model book. What's a model book? A model book is going to, it's where you find the type of setups that you're interested in, you clearly define them, and then you go out and you find the best ones that have already worked, and you study those. And then when another one of those pops up, you have something to evaluate it against. And then you could say, how closely is this one to the model? And if it lines up, then all systems are go. But the math absolutely has to work. Let's see, well, what other questions do we got? Moving into the Q&A portion. Q&A portion. Let's go. What are the questions that you have? That was a really good one, Caleb. Thank you for posting that. And by the way, everybody, if you're not already on our free weekly, actually, no, it's not a weekly newsletter. We're sending it out multiple times a week. I'm aiming to begin sending it out daily. Daily education, daily tips. Might even throw in a trade that I'm in that I could point to and give some educational pointers on. All those things for free in our newsletter. So if you're not already in our newsletter, go sign up for the free newsletter, marrowwealth.com/newsletter. All right, let's see. Well, what other questions came in? Caleb has another question about danger signals. So what's the number for a quote unquote a lot of danger signals? I'll give you what my answer is, right? And here's the thing with danger signals too. I have the things that I look for danger signals. They're significantly important to me because I've studied all these things. If you haven't studied these things, then it's just what some guy has to say. And then when you're looking at these things in real time, you're like, I don't know, I kind of like this. And that's how you get all tied up and twisted. So you need to actually go and study these things and build a real belief in it. Otherwise, it's just noise. But to answer your question about what I consider a lot of danger signals, is it varies based on where I'm at in the trade. So for example, let's go back to Duolingo. When I first bought Duolingo, my threshold for danger signals was 6, right? 6 danger signals. So on this day, right? So I bought it here. On this day, it was 6. On that day, it's 6. Until I was able to get my stop to break even and I started to take something off the table, my threshold was 6. Once my stop is at break even, then I'm playing with the house's money. Then I enter what I call the mid game. The mid game is where I'm trying to get my average gain on this thing. And what's my average gain? I told you it's roughly 10% or so historically, 10, 15%. But it's also taking a look at what's my recent average gain, because in hot markets, trades run further. In cold markets, trades don't work at all. So that's how we can adjust. It's one form of progressive exposure. I talk about progressive exposure a lot in my other book, the Trading Mind Wheel. So when we're in the mid game, I start to look at 7 danger signals as time to take immediate action. And immediate action can vary. Immediate action is either selling some, selling all, or aggressively raising my stop, like to right underneath the low of day. Then when we start to get into the end game, right? So I've already scaled out, I've achieved my average gain, and now I'm trying to let this thing run. Then it's going to take, if I see 9 danger signals, then all right, that's it. The momentum is shifting. And it's not pie in the sky stuff. It's me having gone back through my prior trades to see how many did it take for it to start rolling over, right? Some reason that how many licks does it take to get to the center of a Tootsie Roll Pop thing popped into my head. That's oh boy, oh boy. Anyway, so but I would look for at least 9. When I see 11, it's like, all right, that's enough for me. I'm not going to sit around and wait for Vert to turn around. And let's bring Vert back up here, right? Because I never know and we never know what's going to happen after, right? Nobody can predict the future. But we are able to assess odds, and we're able to assess odds based on history. This one had 11 danger signals on this day, and it was still trading above the 21-day moving average. It was still trading above this ascending trend line, which it's held. I didn't know that it was going to do this today and break down further. And now it's down another 2.5%. If you don't have plans ahead of time, that's when you could start to give back more profits than what's needed, right? So I'm settling there at the end of the day. Would have given up another 2.5%. Maybe if price closes there, maybe it's like, oh, you know what? It's not that far from my backstop. You know what? I think I'll just hold it, right? And that's the kind of conversation that you can have with yourself if you don't have a plan. That's why having a plan is so important. And you might say, well, my plan doesn't account for all this stuff. Yeah, nobody's plan accounts for everything. That's why your plan, your business plan is a living document. As you gain more experience, your plan can and should get better. The plan that you make today will not be as good as the plan that you make next year or 5 years from now, right? You don't want to, it would be like if you're stuck in first grade forever, right? We need to evolve, and so should your plans. Oh man, yeah, I am dating myself a little bit with the Tootsie Roll comment. Anyway, let's see. Well, what other questions are there? What other questions do you guys have? Yeah, here's a question. I understand the importance of gradually building exposure, but how do you deal with the fear of missing out when a stock is breaking out and everybody else seems to be jumping in? Or how about this? When price is breaking out, but the market stinks. Right. Well, when I took this trade back here, this was August 5th, started in VIRT. Let's take a look at what the market was doing. August 5th. Here's August 5th. Did that look like a great day to be buying stocks? The answer is no for most people. Most people are not going to be buying stocks here. Meanwhile, I'm buying VIRT. But to answer this question too, right? Well, when the stock is breaking out and everyone else seems to be jumping in and you're being fearful, it really is how does this trade fall into your plan. You shouldn't be following somebody on the internet. You shouldn't be following somebody on the news. Heck, you shouldn't. And this, I'm speaking directly to our members, right? So if you're in the research program, you're in the coaching program, you shouldn't be buying just because I say it. You should be buying something because it fits your plan. That's the only reason to be buying. And if you don't have a plan, then you shouldn't be buying. If you don't have a plan, you don't have a business. You have a hobby. Hobbies cost people money. Businesses make people money. So if you want to be making money and you want to be making money consistently with trading, you need to have a business, not a hobby. So, I'm feel like I've been beating this drum a lot about business plans, and I hope that it's sinking in, because if not, then this is what's going to happen. And yeah, Caleb, everybody has a plan until they're punched in the mouth. Guess what? If you have a plan, you also know when to duck. You also know when to block. You also know when to sell when the market moves this way or that, and you're not questioning it. Yesterday, one of the things that I mentioned in our chat room for our group coaching members, well, we've got a private chat room. One of the things that I mentioned was that, well, this stock here, when it started to reverse and do this, I used to have that conversation with myself of, oh man, well, which way is it going to go? Maybe I should hold on. It's been a winner, yada, yada. Because of this danger signals and the trade management and having all that stuff in the plan and having this indicator here be able to flag it all. I used to do all that stuff manually because of how valuable danger signals are. But because I've got this, and by the way, this indicator is for free. Because I'm able to just go and look and see, oh, wow, there were 11 yesterday. Sold. Right there, there's no hesitation, there's no stress, all that mental capital that's just flying out the window. No, your mental capital is even more important than the physical capital, because if you lose your mental capital, guess what's happening next? We are a little bit over, so let me know if you have any other questions. Any other questions? I'm happy to stick around for a little bit longer. Happy to stick around for a little bit longer, but let me know if you have any additional questions. In the meantime, though, if you would like to work with me and get more personalized guidance on how to improve your trading strategy, then I'd love for you to join me in my research program. I'm offering a free 2-week trial right now, and this program will help you learn the basics of pattern recognition, stop loss principles, plus a whole lot more. You'll be looking over my shoulder and seeing the trades like the trades that we outlined earlier that we spoke about with VIRT and Duolingo. There's a whole bunch of other ones. You'll get all that, and you could try it out for free for 2 weeks, and I will drop that into the chat as well. And let's actually, why don't I share the screen? Share the screen again. Right, you could go over to Merrill Wealth, go to research, and there it is. But I will give you guys the link. There's the link. Here's what Caleb has to say about the program. My trading, and more importantly, my risk management has improved since joining Merrill Wealth. Thank you, Caleb. Yeah, it's trading is not about getting rich quick. Can you make a lot of money quickly? Yes, you can. Can you lose a lot of money quickly? Yes, you can. The math has to work. The odds have to work. That's why a big part of what we end up what we try to teach inside of this program. Any other questions? Alrighty, then let's wrap it up. Remember that trading isn't about, it's not about trying to catch up as fast as you can. It's about making smart decisions over time and staying disciplined, especially when it feels like everyone else is winning and you're missing out. Stay focused on your plan. Build your positions gradually and avoid the urge to overexpose yourself just because you're feeling underinvested. Trading is a long game, and the traders who succeed are the ones who can stay cool under pressure and follow their process. So I want to say thank you for joining me today. It's been great. Keep pushing forward, stay disciplined, and I'll see you on the next episode of the Traders Mindchat Show. That is it for today. Have a wonderful rest of your day. Have a great weekend, and God bless. Hey, thanks so much for sticking around to the end. If you're new here, hit the subscribe button down below and become a part of the Mara Wealth community. And make sure that you check out some of the other videos on the channel. They're exactly what you need to see. And leave a comment down below. I read all of them. Leave a comment.